Before investing in any company, what is the one document that you are supposed to read? What is one such document which you are supposed to read, refer, analyze before investing in any company? Yes, it is balance sheet. Hello everyone, I'm Rakshith Pai and today I'm going to explain you what are the 4 important aspects that you are supposed to refer, analyze before investing in a company. So, what is balance sheet? Balance sheet is a document that provides financial information. It provides information with what the financial position of the company is. It gives a clear distinction between what are the assets and what are the liabilities of the company. This way, we will get to know what is the financial health of the company. At any particular point of time, you can arrive at the company's financial wealth, the company's net worth, by checking out the balance sheet of the company. Hence, it is very important to read, analyze what is there in the balance sheet and come up with a better judgment over whether to invest in the company or not. There are 3 main components in a balance sheet. Number 1, it's asset. Number 2, it's liability, and the third one, it's shareholders' equity. Assets are what the company owns. These assets will be valued each year, and in case of appreciation or depreciation, the same will be valued and presented in the balance sheet accordingly. Assets are used by the company in order to produce goods or provide services or both. It is the economic value of the asset being valued and the same is provided in the balance sheet. Assets can be further segregated into long-term assets and short-term assets. Long-term assets are those fixed assets which cannot be converted into cash or cash equivalents within or in a reasonable span of time, wherein short-term assets are such assets which can be converted into cash equivalents within a very short period of time. For example, long-term assets are something such as land, building, even motor vehicles can be of a long-term asset. In case of short-term assets, it's cash and cash equivalents such as bank deposits, savings, FT, money market instruments, bonds. Company can also own bonds and equities also. So these are all considered as short-term assets. The second important component is liabilities. Liabilities are something that the company owes to outsiders. It is an obligation to settle all the dues, the liabilities at some point of time in future. Liabilities can be owed to either the shareholders of the company or other stakeholders. Stakeholders in the sense it can also be employees, the other management, top managerial persons, creditors from whom we purchase goods, and other individuals. The third component is shareholders' equity. Now, shareholder is an individual who owns vested interest in the company whilst holding equity shares in the company. He or she will be the owner of the company. In this case, he or she will be the part owner of the company to the extent of shares they are holding. So the principle is asset is equal to liabilities plus shareholders equity. Now coming to the main important question. What are the 4 important aspects that you are supposed to refer whilst reading the balance sheet? Number 1, it is understand the business. Remember, every business has a story behind it and the story is represented in numerical form in a balance sheet. So read the balance sheet and understand the story behind the company. If you know what the company does for generating its revenue, if you know what the company is providing either goods or services, and if you understand how that part of market works, then it's very easy for you to understand how the business operation works. Once you know how the business operation works, it's easier for you to do the number crunching. Yes, number crunching is very important. It is only possible when you know the economics behind how the company works. So yes, understand what does the company do for its living. The second important component is source of capital. A company which is funded only via equities is considered more diluted than a company which is funded otherwise. So a right mix between equity and debt is very important here. Check out the company's capital portion of the balance sheet and you will get more information about this. For example, check out ITC Limited balance sheet and check out their equity dilution. You will get your answer. One more example. If you look at Mr. Buffett's Berkshire Hathaway, the reason for the equity's high price is because the management did not let the company to dilute its equity shares. So yes, it is very important to know what are the sources of capital. Now when you know what are the different sources of capital for the company, it is also important to know what are the cost of capital. Now that is our third important component. What is the cost of capital? In order to not put pressure on the company's working capital, in order not to put company's financial situation, it is very important to have cost of capital at low as possible. So let me explain how. Return on capital employed is nothing but a capital is employed and the return that is coming out from the employed capital. So suppose the return on capital employed is at 7% and the cost of capital is at 4%, then the margin of 3% is what you're seeing is operating profit. So an investor must check the industry average of cost of capital and compare it with the company's average cost of capital. This way you can arrive at whether the management is efficient in its capital allocation and capital management, and whether is it efficient to get cheaper or most affordable way of capital. The fourth and the most important aspect that we should check for is whether the company has settled all its statutory dues, or and whether the company has any such issues that are considered illegal or that is battling some legal disputes. Now, whenever I am reading a balance sheet, I will always be in a skeptical mode. So, whenever I am reading a balance sheet, I'll see what are the issues that I can find in the company and see how it fits with the company's main mission vision statements. So, if you see any issues where company is not able to meet its dues, then that is one of the biggest red flag there ever can be. So, if a company is unable to meet its required capital dues, if a company is not able to meet employee compensations, taxes, unpaid other charges, legal disputes which are hanging in the balance sheet for over a long period of time, then this has to be taken very seriously. So that's it for today, and these are the four important aspects that are to be referred while reading the balance sheet of a company. Check out the link in the description. I have written a complete article about this topic. I have given 10 important topics, 10 important aspects that are to be considered while reading a balance sheet. Check out the link. Thank you.